After studying this module, you shall be able to understand the procedure of allotment of security, identify and develop an understanding of the various financial instruments introduced recently like floating rate bonds, zero interest bonds, deep discount bonds, municipal perpetual bonds, inverse float bonds, collateralized debt obligation, securitized papers, fully convertible bonds, non-convertible debentures. We shall commence this module by studying about the financial markets. The financial market have an important relationship with the economic development. A company decides to issue securities for different reasons. The main reason being raising capital to meet its financial requirements, maybe for the starting a venture, repaying debts, expansion and diversification. In India, company planning to issue securities shall abide by the relevant provisions of the Securities Contract Regulation Act 1956, Security Contract Regulation Rules 1957, Companies Act 2013, hereinafter referred to as an act, and the Companies Prospectus and the Allotment of Securities Rules 2014. Security and Exchange Board of India Act 1992 and the rules and regulation made thereunder. Let us now understand the security allotment procedure. Rules related to the allotment of securities. Under Section 39 of the Act prohibits allotment of securities where the minimum amount as stated in the prospectus has not been subscribed. This section further provides that for the refund within the given time frame. It provides that all of the minimum amount must be received with the period of 30 days from the date of issue of the prospectus or such other period as may be specified by the Security and Exchange Board. If the minimum subscription remains unsubscribed, it shall be returned within the such time and manner as may be subscribed. The rules provide that where the stated minimum amount has not been subscribed and the sum payable on the application is not received within the period specified therein, then the application money shall be repaid within the period of 15 days from the closure of the issue, and if any such money is not so repaid within such period, the directors of the company who are the officers in default shall jointly and severally be liable to repay that money with the interest at the rate of 15% per annum. The application money to be refunded shall be credited only to the bank account from which the subscription was remitted. The section provides that the minimum amount of every security shall not be less than 5% of the nominal amount of the security or such other percentage or amount as may be specified by the Security and Exchange Board by making regulation in this behalf. A company having a share capital makes any allotment of the securities shall file with the registrar a return of the allotment in such prescribed manner. The rules provide that whatever a company having a share capital makes any allotment of its security, the company shall within 30 days thereafter file with the registrar a return of allotment in form PAS3 along with the fee as specified in the company's registration offices and fees rules 2014. The rules further provide for the attachment to the form PAS3, that is, return of the allotment as under. A list of allottees stating their names, address, occupation, if any, and number of securities allotted to each of the allottees. The list shall be certified by the signatory of the form PAS3 being complete and correct as per the records of the company. In case of the security not being bonus shares allotted as fully or partly paid up for the consideration other than the cash, there shall be attached to the form PAS3 a copy of the contract being duly stamped pursuant to which the securities have been allotted together with any contract of sale if relating to the property or an asset or a contract for the service or other consideration. A report of registrar valuer in respect of the valuation of the consideration other than the cash shall also be attached along with the copy of the contract. In case of the issue of the bonus share, a copy of the resolution authorizing the issue of such share shall be attached to the form PS3. All money received on the application from the public for the subscription to the securities shall be kept in the separate bank account in the scheduled bank. Such money can be utilized only for the following two purposes. First, for the adjustment against the allotment of the securities where the securities have been permitted listing, or B, for the repayment of the monies within the time period specified by the Security and Exchange Board received from the applicants in pursuance of the prospectus where the company is for any other reason unable to allot the securities. Procedure of security allotment. First, in case of the issuer company makes an issue of 100% of the net offer to the public through 100% book building process, not less than 35% of the net offer to the public shall be available for the allocation to the retail individual investor. Not less than 463, that is 15% of the net offer to the public shall be available for the allocation to non-institutional investor, that is investor other than the retail individual investor and qualified institutional buyers. Not more than 50% of the net offer to the public shall be available for the allocation to the qualified institutional buyers. Second, in case an issuer company makes an issue of 75% of the net offer to the public through book building process and 25% at the price determined through book building. In the book build portion, not less than 25% of the net offer to the public shall be available for the allocation to the non-qualified institutional buyers, and not more than 50% of the net offer to the public shall be available for the allocation to the qualified institutional buyers. The balance 25% of the net offer to the public offer at a price determined through book building shall be available only to the retail individual investors who have either not participated or not have received any allocation in the book build portion. Third, allotment to the retail individual investors, non-institutional investor and qualified institutional buyer shall be made proportionately as illustrated in the Schedule 18th. Fourth, the broker shall refund the marginal money collected earlier within 3 days of the receipt of the basic of the allocation to the applicants who did not receive allocation. Fifth, allotment shall be made not later than 15 days from the closure of the issue, failing which interest at the rate of 15% shall be payable to the investors. Sixth, on the payment and receipt of the sum payable on the application for the amount towards minimum subscription, the company shall allot the shares to the applicants as per the guidelines. Seventh, in case the issuer company has made an issue of 75% of the net offer to the public through book building process and 25% at the price determined through book building, the offer of 25% of the net offer to the public made at a price determined through book building shall open within 15 days from the date of the closure of the bidding. The offer of the subscription to the public shall remain open for the period of at least 3 working days after completing all the requirements of the advertisement and dispatch of issue material to all the stock exchanges. During the time when the offer is open, the investor who have received an intimation of the entitlement of the securities under sub-clause of 18th of the clause 11.3.1 shall submit the application forms along with the application monies. The other retail individual investors who had not participated in the bidding process or have not received intimation of the entitlement of the securities under sub-clause of 18 of clause 11.3.1 may also make an application. Now, we shall discuss the new financial instruments in the primary market. The capital market is an important source of the meeting the growing long-term financial requirements of corporate both in private and public sectors. On the other hand, due to the colossal fund requirement of the both corporate and the financial institutions, the competition becomes intense among the various classes of issuer to corner a share of investor funds, and on the other hand, investors are proving be increasingly savvy. Hence, to cater to the different requirements of the both issuer and investors, it has become essential for the issuer to innovate and design new financial instruments. In order to improve the attractiveness of the bonds or debentures, some new features are added. As a result, a wide range of innovative debt instruments have emerged in India in recent years. Some of the important ones among these are discussed below. Floating rate bonds, FRBs. Floating rate bonds are also known as floating rate notes, are the bonds that have a variable coupon equal to the money market reference rate. The interest rate on these bonds is not fixed and is linked to the benchmark rate or anchor rate. Almost all FRBs have quarterly coupons, that is, they pay out interest every 3 months. FRBs carry little interest rate risk. An FRB has a duration close to 0 and its price shows very low sensitivity to the changes in the market rates. When the market rate rise, the expected coupons of the FRB increase in line with the increase in the forward rate, which means its price remains constant. Thus, FRBs differ from the fixed rate bonds, whose prices decline when the market rate increase. As FRBs are almost immune to the interest rate risk, they are considered conservative investment for the investors who believe market rates will increase. The risk that remain is credit risk. The State Bank of India was the first bank to introduce the bonds with the floating rates for the retail investors. The SBI floating rate bonds were linked to the bank term deposit rate, which served as an anchor rate. The treasury bill rate can also be anchor rate. The interest rate is linked to the anchor rate as it reflects the economic indicators. The NSE MIBOR is used as an anchor rate for floating rate bonds. Zero interest bonds. Zero interest bonds, also known as zero coupon bond, is a bond bought at a price lower than its face value, with the face value repaid at the time of maturity. It does not make periodic interest payments. When the bond reaches maturity, its investors receive its par or face value. These bonds benefit both the issuer and the investors by limiting funding costs when the interest rates are volatile for the issuer and by reducing the reinvestment risk for the investor. Zero interest bonds are sometimes convertible into equity on the maturity, which entails no outflow for the issuer or into the regular interest bearing bond after a particular period of time. Zero interest bonds have duration equal to the bond's time to maturity, which makes them sensitive to any changes in the interest rate. Investment banks or dealers may separate coupons from the principal of the coupon bonds, which is known as a residue, so that different investors may receive the principal and each of the coupon payments. This creates a supply of new zero coupon bonds. Companies such as Mahindra and Mahindra, HB Leasing and Finance have pioneers in introducing these bonds in the Indian market. These bonds are the best options for the individuals and the institutional who look for more safe and good returns and ready to hold bond till maturity. Moreover, these bonds do not carry any interest which is otherwise taxable. Deep discount bonds, DDBs. A deep discount bond is a zero coupon bond whose maturity is very high and is offered at a discount to the face value. Maturity period of these bonds are more than 15 years. The Industrial Development Bank of India, IDBI, was the first financial institution to offer deep discount bonds in 1992. The issuers have successfully marketed these bonds by luring the investors to become a Lakhpati in 25 years. Moreover, these instruments are embedded with the call and put options, providing an early redemption facility both to the issuer and the investor at the predetermined price and the date. The issuer becomes free from the intermittent cash flow problems and the funds can be deployed in the infrastructure projects which involve long periods. Municipal bonds. Municipal bonds are securities that are issued by the municipal corporation of the city for the purpose of financing the infrastructure needs of the issuing municipality. These needs vary greatly, but it includes schools, streets and highways, bridges, hospitals, public housing, sewer, water systems, power utility and various public projects. These bonds were made saleable through the government guarantee. The issuer of the municipal bond receive a cash payment at the time of issuance in exchange of a promise to repay the investor who provide the cash payment, the bondholder, over time. Repayment periods can be short as a few months, although this is rare, to 20 to 30 or 40 years or even longer. Municipal bonds holders may purchase bonds either directly from the issuer at the time of issuance on the primary market or from the other bondholder at some time after the issuance on the secondary market. In exchange for an upfront investment of the capital, the bondholder receives the payment over time composed of interest on the invested principal and a return on the invested principal itself. The Indian municipalities need a huge sum to finance a number of the basic projects, and the financial health of the municipalities is in a poor state. To cope up with the financial requirements, new type of debt security was introduced by the government in form of the municipal bonds. The Ahmedabad Municipal Corporation was the first urban local body to raise funds through the municipal bonds. It was the first urban local body to receive a journal obligation rating for its municipal bonds in the February 1996 and raise funds through municipal bonds without a state government guarantee. The Bangalore Mahanagar Palika (BMP) was the first to issue municipal bonds for Rs 125 crore within 7-year maturity and a coupon of 13% annum in December 1997. Perpetual bond. Perpetual bond, which is also known as perpetual or just a perp, is a bond with no maturity date. Therefore, it may be treated as an equity, not as a debt. Issuer pay coupons on the perpetual bonds forever and they do not have to redeem the principal. Perpetual bond cash flows are therefore those of a perpetuity. Inverse float bond. Inverse float bonds are the bonds carrying a floating rate of interest that is inversely related to the short-term interest rate. The floating rate could be MIBOR, that is Mumbai Interbank Offer Rate. The MIBOR falls, the return for the investors rises and vice versa. The actual rate payable on these bonds is arrived by subtracting the floating rate from the fixed benchmark rate. Suppose the fixed benchmark rate is 12% and the 6-month MIBOR is 7%. Then the interest rate payable on these bonds is 5%, that is 12% minus 7. These bonds enable investors to earn high returns in the low interest rate environment. As interest rates are highly volatile, the investors has to observe the interest rate behavior carefully over the entire bond period, else he could end up getting a poor return. Thus, both the investor and the issuer have to hedge the interest rate risk. If the interest rate goes up, the issuer benefits as the coupon rate of his bonds will decline in spite of the higher interest rate. Inverse float bonds are the latest entrants into the Indian capital market. The Aditya Birla Group, Grasim and Hindalco issued inverse float bond in August 2002. The Cholamandalam Investment and the Finance Company Limited were the first non-banking financial company to raise funds through the issue of the inverse floaters. Collateralized debt obligation (CDO). Collateralized debt obligation is the securitization of the corporate obligation such as corporate loans, corporate bonds and assets-backed securities. Collectively, collateralized debt obligations consist of the collateralized bond obligations, collateralized loan obligations and credit-linked notes that emanate from the same financial family. Banks and financial institutions use this instrument to meet regulatory obligation and to increase their revenues. The structure of CDO consists of multiple layers called tranches, which are formed by pooling underlying assets. Each tranche will have a pool of asset from the corporate loans and bonds of the similar seniority and maturity. These tranches are then rated by the credit rating agency and marketed. The ICICI Bank's first CDO issued failed to take off in March 2002 and recalled because of unfavorable market conditions and lack of regulatory guidelines. In February 2004, the bank altered the product structure by bringing down the average maturity of the issue to around 2 years. The rupees 100 crore CDO issue was mopped up by the institutional investors. The ICICI Bank sold corporate loans given to 15 borrowers of varying size across 11 industries through this issue to raise new assets as well as enhance exposure management in terms of specific sectors. Securitized papers. Securitization is the process by which a company raises money by selling off its receivables. These receivables are sold off to the cash-rich investors by converting them into the securities. The receivables are sold at a discount to the investors, which represents the yield. It is a process through which illiquid assets are packaged and converted into the tradable securities known as pass-through certificates, PTCs. These securities are also referred to as an asset-backed securities, ABSs. If the instrument securitized is as housing loan, the resultant instrument is referred to as mortgage-backed securities, MBSs. In securitization, the assets to be securitized are identified on the basis of their creditworthiness. Then, the security is rated by the specialized credit rating agency. The pool is sold to a special purpose vehicle, which act as a trustee. The SPV, special purpose vehicle, is the entity that owns the asset once they are securitized. The assets are held by the SPV to ensure that the investor interest is secure even if the originator goes bankrupt. The SPV issues the asset-backed security, and the task of the collecting the interest due on the underlying asset is left either to the seller or the third party. The securities can be listed on the NSE. As the securities are negotiable instruments and listed, they can be treated in the secondary market. Since the securities are the asset for the seller, the process is called as an asset securitization. However, once it is listed on a stock exchange, it becomes a debt product for the investor, and hence the process is called debt securitization. The Securitization and Reconstruction of the Financial Asset and Enforcement of the Security Interest Act 2002. The Government of India in 2002 June introduced this act to regulate the securitization and the reconstruction of the financial asset and enforcement of the security interest. The act provides the first legal framework that recognizes securitization, asset recovery and reconstruction. To create a market in a securitized debt, the government has floated a company called Asset Reconstruction Company India Limited, ARCIL, wherein the government holds 49% stake, ICICI a 25.5% stake, and rest is held by the financial institutions. For securitization to grow up at a rapid pace, there is a need to increase the investor base by persuading public sector bank, provident funds, trust, and the financial institutional investors to invest in this market, develop standard procedures and accounting standards, introduce change in the tax laws, and develop an active secondary market. The dealing in the securitized instrument need to be transparent. A formal regulatory framework for the securitization is needed. Fully convertible bonds, FCDs, a type of debt security where the whole value of the debentures is convertible into the equity shares at an issuer's notice. The ratio of the conversion is decided by the issuer when the debenture is issued. Upon conversion, the investor enjoy the same status as ordinary shareholders of the company. The main difference between FCD and the other convertible debenture is that the company can force conversion into equity, wherein the other types of convertible securities, the owner of the debenture may have that option. FCDs also differ from the partially convertible debentures. In case of PCDs, part of the instrument is redeemed and a part of it is converted into equity. Non-convertible debentures, NCDs. Non-convertible debentures means a debt instrument issued by the corporate holding, including NBFCs, with the original or the initial maturity up to the year and issued by the way of the private placement. A corporate shall be eligible to issue NCDs if it fulfills the following criteria, namely, the corporate has a tangible net worth of not less than Rs 4 crore as per the latest audited balance sheet. The corporate has been sanctioned working capital limit or the term loan by the bank or all India financial institution, and the borrowed account of the corporate is classified as a standard asset by the financing bank or the institution. An eligible corporate intending to issue NCD shall obtain a credit rating for issuance of the NCDs from one of the rating agencies like the Credit Rating Information Services of India (CRISIL) or the Investment Information and Credit Rating Agency of India Limited (ICRA) or Credit Analysis and Research Limited (CARE) or Fitch Rating India Private Limited or such other agencies registered with the Security and Exchange Board of India or such other credit rating agencies as may be specified by the Reserve Bank of India from time to time. Procedure of the issuance of the NCD. The corporate shall disclose to the prospective investors its financial position as per the standard market practice. The auditor of the corporate shall certify to the investor that all the eligibility conditions set forth in these directions for the issue of NCD are met for the corporate. The requirements of all the provision of the Companies Act 1956 and the Security Exchange Board of India issue and listing of the Debt Security Regulation 2008 or any other law that may be applicable shall be complied with by the corporate. The debenture certificate shall be issued with the period prescribed in the Companies Act 1956 or other law as at the force at the time of issuance. NCD may be issued at the face value carrying up a coupon rate or at a rate of a discount to the face value as zero coupon instruments as determined by the corporate. We shall recapitulate what we have learned so far. In India, a company planning to issue securities shall abide by the relevant provisions of Security Contract Regulation Act 1956, Security Contract Regulation Rules 1957, Companies Act 2013, hereinafter referred to as an Act, and the Company's Prospectus and Allotment of the Security Rules 2014, Securities and Exchange Board of India Act 1992 and the Rules and Regulations. In case of the public company, which is listed entity or is desirous of listing its securities on the recognized stock exchange in India, the issue of the securities is governed by the Companies Act, Security Control Regulation Act 1956, the SEBI Act 1992 and the issue of the Capital and Disclosure Requirement Regulations 2009. In case of all issues by the private companies, the same is governed by the Companies Act and the power of administration is exercised by the central government, the tribunal or the registrar of the companies as the case may be. In today's financial marketplace, financial instruments can be classified generally as equity-based, representing ownership of the asset, or debt-based, representing a loan made by an investor to the owner of the asset. Foreign exchange instrument comprising a third unique type of instrument. New financial instruments in the primary markets are floating rate bonds, zero interest bonds, deep discount bonds, municipal bonds, perpetual bonds, inverse float bonds, collateralized debt obligations, securitized papers, fully convertible bonds and non-convertible debentures.